Real talk. Today, July 24th, 2026, something is happening in China that most Americans will never even hear about on the news. The world's largest bank, ICBC, along with three other major Chinese banks, just permanently shut down retail paper gold trading. Now, you're probably thinking, okay, cool, who cares about Chinese banking news? Here's why you should care. Gold hit $5,589 an ounce earlier this year. That's a jaw-dropping 65% gain throughout 2025 alone. And what China just did today reveals something about gold that most Americans, including most investors, have never understood. Stick with me for the next 4 minutes. By the end, you're going to see the gold market completely differently. Let's get into it.
The gold you see isn't the gold that moves. Here's something almost nobody realizes. The gold price you see on your phone every day, it has almost nothing to do with actual gold changing hands. Picture it like this. Imagine I own one car, but I sell 10 different people an IOU that says you own a piece of this car. That doesn't create 10 cars. It just creates 10 people who all believe they have a claim on the same car. That's basically how the gold market has worked for decades.
Less than 1% of all gold contracts traded ever result in real physical gold actually moving. The other 99%? Just paper, settled in cash, no metal involved. And here's where it gets darker. Multiple major banks have been caught manipulating gold prices, placing massive orders they never planned to fill just to move the price in their favor. They paid real fines for it. That's not conspiracy theory. That's public court record. So when China's biggest banks shut down paper gold trading today, that's not a random banking headline. That's a crack in a system that's controlled the price of gold for decades.
What actually happened today? Here's exactly what went down. ICBC, the world's largest bank by total assets, announced it will cease offering individual gold trading products linked to the Shanghai Gold Exchange after today's clearing session on July 24th. ICBC isn't alone. Postal Savings Bank of China, Ping An Bank, China Guangfa Bank, and China Construction Bank all issued identical wind-down notices. Existing customers were given 3 options: close their positions, cash out, or take actual physical delivery of real gold before the deadline. The official reason? Protecting retail investors. And honestly, that part checks out. Gold peaked near $5,600 an ounce in January. Then it plunged 30% to below $4,000 by June. Chinese banks responded by raising margin requirements to 140%, effectively making leveraged gold trades too expensive to hold. China's banks have seen this exact movie before. Back in 2020, a similar retail oil product collapsed when oil went negative, leaving ordinary investors owing money on trades they never thought could go below zero. One bank took close to $1 billion hit. So on the surface, this is China protecting regular people from getting destroyed by volatile leveraged bets. But zoom out, and a much bigger pattern shows up.
The bigger picture nobody's connecting. Here's where it gets genuinely interesting for American investors. Central banks around the world added more than 700 tons of gold in 2025, buying at the fastest pace since the 1960s. Global gold ETF inflows hit $89 billion in 2025, the largest ever recorded. Global gold ETF assets doubled to $559 billion. And China specifically has been reportedly adding to its official gold reserves for 20 straight months, while simultaneously building physical gold vaulting infrastructure across Asia. So here's the pattern. Less paper gold exposure at home, more physical gold infrastructure globally, and now shutting down the retail paper channel entirely.
Here's the simple truth behind all of it. When a government runs massive deficits and gets its credit rating downgraded, investors start looking for assets the government cannot print more of, cannot inflate away, and cannot confiscate. Gold has played this role for thousands of years. And in 2025 and 2026, this role has been more pronounced than at any time in modern financial history. China isn't running away from gold. China is choosing the real thing over the paper version of it.
Paper gold versus real gold. Know the difference. Here's what every American needs to understand before touching gold. Paper gold, a contract, a promise, exposure to the price. Cheap, easy, instant. But you're relying entirely on whoever is on the other side of that trade to actually be good for it. If they're not, you get cash. Maybe, if you're lucky. Physical gold, the actual metal. No counterparty. Nobody can freeze it. Nobody can default on it. Nobody can quietly create more claims than there's metal to back them. Easiest way to remember it. Paper gold is a receipt. Physical gold is the thing the receipt was supposed to represent. And what China just did today, forcing every retail customer to choose between cash or actual metal, is basically them drawing that line in the most public way possible.
Global gold investment demand surged 84% in 2025. This isn't fringe anymore. This is mainstream money asking the same question China just forced its customers to answer today. Do I actually own this? Or do I just own a piece of paper that says I do? That question matters whether you own gold, stocks, crypto, or anything else. Subscribe to Darwinomics. Every week we break down what's really happening with your money. No fluff, no spin, just the truth. Physical gold or paper gold? Which one do you own? Drop it below. I'm Darwin. Stay sharp. Peace.